I want to show you a number that is quietly making millions of people feel like failures, even when they are doing everything right. It is not a number you will find on your bank statement. It is the invisible mechanism behind why your paycheck seems to evaporate before it even hits your account. In July 2026, we are witnessing a strange phenomenon. According to a recent study by FINRA, there is a widening knowledge-confidence gap. Investors today have higher subjective confidence than ever before, fueled by a constant stream of algorithmic content. Yet, these same investors are scoring lower on objective financial literacy tests than they did 5 years ago. This is not just a statistical quirk, it is a diagnostic indicator of a systemic breakdown. We are living through a collision between a generation and a volatile economic calendar. The old benchmarks for success are broken, and the new ones are written in a language most do not speak. I spend way too much time pulling apart these moments. If you do not understand the structural forces at play, you will spend your life fighting a ghost. This is the sophisticated reality of 2026. To understand why you feel behind, we have to look at the concept of the doom loop. It starts with a psychological principle called loss aversion. Behavioral finance tells us that the pain of losing money is twice as powerful as the joy of gaining that same amount. In the volatile markets of 2026, this bias is being weaponized by the sheer speed of information. When you see a dip, your brain treats it like a physical threat. This leads to panic selling at the absolute bottom. This behavior has become a hallmark of the digital age investor. But there is a second layer to this trap: doom spending. Current data shows that 41% of Gen Z admits to engaging in impulsive, emotionally driven consumption. They see housing prices that feel unreachable and geopolitical tensions that feel unavoidable. Their brains demand a shortcut to safety. That shortcut is a dopamine hit from a high-end gadget or a luxury experience they cannot truly afford. It is a loop where short-term dopamine permanently exacerbates long-term debt. Let us look at a case study to make this math concrete. Meet Marcus. He is 28, earns $95,000 a year, and should be thriving. But Marcus is stuck in the doom loop. He is anchored to the housing prices of 2021, refusing to accept the current market fundamentals. This anchoring bias makes him feel like he has already lost. He stops saving for a down payment and spends that money on premium subscriptions and tech hardware. He is suffering from present bias, the tendency to overvalue immediate rewards over future ones. Marcus is not irresponsible. His behavioral stamina is simply being drained by the world. If Marcus continues this path, he is not just losing money. He is losing time, which is the only asset that truly compounds. Everything changed with the passage of the One Big Beautiful Bill Act, or OBBBA, in 2025. This legislation has fundamentally rewritten the rules of wealth preservation. The tax efficiency landscape has shifted significantly. Higher standard deductions are now set at $16,100 for individuals and $32,200 for joint filers. Strategic planning in 2026 is no longer about picking the right stock. It is about tax bracket management. We are currently in a golden year for intergenerational gifting. The lifetime estate tax exemption is sitting at a historic high of approximately $15 million. Yet, most ordinary people are ignoring the infrastructure layer of their wealth. They focus on top-line earnings while the economy quietly eats the margins. This is the two-bucket problem. One bucket is what you earn, and the other is what you keep. If you are not optimizing for after-tax returns, you are essentially running a race with a parachute deployed behind you. You must prioritize Roth conversions and asset location. Keeping high-tax assets in tax-advantaged accounts is now a requirement for survival in the OBBBA era. While the tax code is changing, so is the very definition of an asset. In June 2026, a global initiative introduced a concept every high performer now uses: brain capital. We are living longer, but we are also facing a world that requires more complex problem-solving than ever before. This has led to the rise of the third quarter plan. We used to think of life in two halves: work and retirement. Now we have to plan for the years between 50 and 75 as a period of high-level contribution. Longevity risk is the danger of outliving your money, but the greater risk is outliving your cognitive capacity. High-net-worth individuals are now investing in brain health as a core financial asset. They understand that their ability to navigate the 2026 economy is tied directly to their cognitive longevity. If your brain is your greatest compounding asset, why are you treating it like a depreciating piece of hardware? You need to protect your cognitive capacity through continuous education and health protocols. In a world of agentic AI, the only thing that cannot be automated is your unique ability to solve high-stakes problems. Speaking of automation, 2026 is the year where technology as a nudge became a reality. We have moved past simple budgeting apps. We are now in the era of agentic AI agents that act on your behalf. These tools do not just tell you that you spent too much on coffee, they automatically move idle cash into high-yield accounts and execute tax loss harvesting without you ever lifting a finger. The results are staggering. Users of these AI-driven finance tools saw an average 34% increase in their savings rates in early 2026. This is the submarine strategy, running silent and letting the systems handle the noise. While the rest of the world is distracted by the latest finfluencer scam, the sophisticated realist is automating the rational. Research shows that 68% of Gen Z makes investment decisions based on social media, yet those followers are 3 times more likely to be victims of financial fraud. Regulators have started to crack down, but the damage for many is already done. They were looking for a signal in a room full of noise. You have to understand that the loudest voices in the room are often the ones with the least to lose. Real wealth in 2026 is built in the quiet, in the private markets, and in tokenized real estate sectors that require behavioral stamina. These assets offer higher potential returns, but they lack the liquidity of a public stock. This lack of liquidity forces you to be a long-term thinker. You cannot panic sell a private equity stake on a Tuesday afternoon because you had a bad day at work. This forced discipline is exactly what the modern investor needs to counteract the doom spending cycle. So, how do we actually navigate this? I want to give you 3 specific, actionable things to do this week. First, you must automate the rational. If you are still manually moving money or rebalancing your portfolio, you are inviting human emotion into a math problem. Use an AI-driven agent to handle the mechanical parts of your finances. This removes the decision fatigue that leads to doom spending. By the time you feel the urge to buy something unnecessary, the money should already be gone, working for you in a high-yield environment. Second, implement a second opinion protocol for any purchase over $500. This is a diagnostic tool to break the dopamine loop. When you feel that surge of excitement, you must wait 48 hours. Is this a response to macroeconomic anxiety, or does it actually serve your long-term third-quarter plan? Usually, the urge to spend is just a symptom of a deeper stress. Identifying the source of the stress is free. Finally, you need to audit your asset location. In the wake of the OBBBA, the way you hold your assets is as important as what you hold. Ensure that your highest tax burden assets are shielded in tax-advantaged accounts. This is the invisible way to increase your net worth without earning a single extra dollar. It is about being an architect of your own wealth rather than just a tenant. The window of opportunity in 2026 is compressing. The difference between those who thrive and those who feel like they are drowning is their ability to recognize invisible economic shifts. We are moving from a world of simple accumulation to a world of complex management. Do not let the broken benchmarks of the past dictate your future. Run silent, automate the rational, and protect your brain capital. That is how you win the long game in an age of noise. I spend my time pulling these things apart because I want you to see the X-ray of the economy, not just the skin. If you can see the bones, you can see where the breaks are before they happen. This is the quiet truth of 2026. The systems are changing, the rules are being rewritten, and the only way to stay ahead is to stop playing the game by the old rules. Look at the data, trust the frameworks, and execute the plan. You are not behind because you are failing. You are behind because the world changed and nobody gave you the new map. Now you have it.